In this episode, we're going to discuss another slow trading week, some lessons that I've learned so far at trading that I've been learned, I just had to relearn, and of course, talking about the Super Bowl, how I feel as a Dallas Cowboys fan. This is Investing in Real Life Show, episode 3. Let's go. Welcome to the Investing in Real Life Show, everybody. This is Sophisticated Investing Life, and this show is primarily to talk about my options trading journey. Last year, I did really well getting started in options trading, actually gained 50% on the year, but it doesn't look like it's going to be that way this year. But I'm going to discuss how things are kind of shaping out so far, right? Also going to discuss the Super Bowl, why I am a big fan of both the Chiefs and 49ers, how their teams have been constructed, and how you can learn a lesson from that, as well as, share some frustration as a Dallas Cowboy fan. With all that said, let's get to the portfolio update. All right, let's get this show started. Now, let's dig deeper. We're going to first take a quick look at the agenda. Like I mentioned before, we're going to touch on the option portfolio. Another week of slowness, and actually, this is a running theme that came forward to me last year, right? This came forward to me last year, and it's like, Michael, you need to learn your lesson, right? So these are some tough lessons that I've learned so far, starting to trade options over the past year or so. These are the 3 main lessons I learned, and I did them all. I did them all in 1 month, right? In a series of trades, I broke all these rules, right? So we're going to touch on that. I'm going to touch on some stock market news that matters. Going to, of course, shout out another financial YouTuber. And, of course, we're going to touch on our real life lesson. We always got to cap off there. Talking about the teams that made it to the Super Bowl, the Chiefs and the 49ers, and what my Dallas Cowboys can learn from them. So let's just jump straight in. First and foremost, this is sad, but I had closed one trade, and that trade is the Broadcom trade, as we see here. But here's the problem. This is the issue. At the end of the day, net P&L from it was $1. Literally gained $1 profit from it, right? Which is like, that's insane. How could you do that? Why did you do that? Why did you close out the trade? Well, let's go back to these tough lessons we learned so far, right? So placing market orders on illiquid stocks and illiquid positions. You can get in trouble doing that, right? So Broadcom isn't the most liquid options contract, and there's actually a number of them that aren't that liquid. But here's the thing. When you're looking at placing the orders, you see one thing from your unrealized profit and loss. So if I scroll down, you will see if everything works out well. Come on, you're gonna load. There you go. So you see this unrealized P&L, right? So you see this and you're like, okay, this is what I'm expected to get at this certain price. But when you close the trade, we actually do market orders. If it's a liquid name, it's something that trades a lot, like for example, the SPY, right, for the S&P 500. Or there are some stocks that are super liquid, like a Goldman Sachs. When I did this for Boeing, this usually isn't an issue. Or like a Tesla. These are super liquid in terms of option contracts, right? Broadcom's not like that. And because it's not like that, it has a wide bid-ask spread. So if we look at the bid-ask spread, so let's say for in particular my position, right? My position is a call. And the bid-ask spread for 340 call is, the bid is $4.30. The ask is $4.50, right? That is a 20-cent gap. And look at the price. And the price is not even in between the bid and the ask like it normally is. Like it's a wide spread. It's a wide spread, right? That's 20-cent difference, right? And if you look over here, it doesn't even align. Like it doesn't even match the market price here. So part of it is me learning how to use this software. Like what you see as the market price, you're nowhere near it, and the software doesn't update quickly. Even if you refresh the page, you got to deal with that. So some of this is just some tough go at it with this software. I'm just, this platform I decided to use because I think I can make enough money over 2 or 3 years that it can actually turn into another revenue source for me. So I just have to deal through these pains and learn from my mistakes. Right. But also, if you're dealing with illiquid contracts where the bid ask spread is at least 10 cents difference, right? It's not that bad if it's a 10-cent difference, and usually you like to be much closer than that. But if it's at least 10 cents, you need to put in limit orders instead of market orders. So when you're closing out the trade, to look more at the spread between these two numbers instead of the market price. These two are the bid ask, and this is the market price. Don't pay attention to the market price. So when I originally looked to close out the trade, instead of me getting a $5 gross P&L and $1 net, when I originally closed out the trade, it was going to be a $25 gross and $21 net, which is something I could live with. But with just 5 and 1, it's kind of like I could have just waited, or I could have just been smarter closing out the trade, right? So that's something that happened. And also, we all remember how much Broadcom was worrying me, so I did something, a little bit of experimentation in terms of doing a combination of rolling a trade as well as putting on a call option to kind of essentially mitigate all losses, right? That was the whole point. Mitigate the losses, if not lose at all. Because some people have, when it comes to trades that are losing, some people have different, various ways to handle it. Some people believe like you should just roll the trade, just continue rolling it to your right. And that's the tasty trade philosophy. And in realized profits, it looks good, but unrealized, you just have to consistently keep rolling and rolling. And this is what happens. This is particularly what happens when the stock market continues to go up. It's a low risk environment, and you put on call credit spreads. And I did just that. This is a low risk environment. I saw a stock that, to be honest, wasn't in real trouble, right? It wasn't in real trouble. Broadcom would have been in trouble if it would have dropped to about $290, right? $290. And I had a credit spread position on at 280, right? So if it would drop to 290, then yes, it would have been an issue. But it didn't drop to 290. It dropped to about 295, 296 at the lowest, and it started working its way back. But when it started dropping and I started seeing that delta start to creep up, I kind of jumped the gun and put on a call credit spread and collected the premium. But now I'm running into an issue. Here where this is a losing position. I closed out the put just fine, even if it was only for a $1 profit. I'm fine with that. I held my discipline. But because I start selling call options when I shouldn't have, like this is not the opportunity to do it. You shouldn't be selling call options, and not until the market environment is a little bit more risky. And when that happens, the market tends to be more range bound, so the stock market doesn't go up. Or if it does go up, it doesn't go up that much. And, you start from there as your basis. Or maybe when the market's tanking, you can sell call options, which you'll make money on. And I knew that. I completely knew that. And I tried to do something different, and it's backfiring on me. And I'm not happy about it, right? I'm not happy about it. And I'm thinking about taking the loss, right? Now, what will I do if I took the loss? If I took the loss, and right now it says this is the price, but I'm going to go with what I saw on Yahoo Finance, which is more like this will be a $200 loss, right? This will be a $200 loss, and that is a lot of money. That's higher than the profits I got, right? So taking an L. Last year I experienced 2 losing months, and I'll tell you more about them in a second, but it was a similar situation where I put on a trade where I shouldn't have put on the trade, and now I'm paying for it, right? So this is something I'm thinking about doing. I'm thinking about rolling the trade. And if I was to roll the trade, for example, this is what I would do. And I believe not necessarily rolling to your right, but you should minimize losses but take a loss, but just minimize the time frame for that loss. So let's say I would to lose $100, right? If we go out 1 month, come on, load up, and we go out of the money here, and I'll replace the call spread with a put spread. So I will first do that. And then I'm going to go all the way out and probably still below at this level, 0.8, well, 0.08 delta. So about an 8% chance of losing. I would sell here, sell the 270. So over the next month, the stock price is now at 324. So it needs to drop about 20%, which is, well, maybe not 20%. Maybe about at least 15, maybe close to 17-18% range. It drops a fair amount, essentially. But I'll sell here, and I'll probably make it a wide credit spread, right? Make it really wide. $30 width, right? So I'll sell here, and I will collect about maybe 137, if I'm getting my math right. So it will limit my loss from 200 to about 70, right? And some people would be like, no, go out an extra month and have the trade on, and at that point you will not have a losing trade. And I'm still thinking about doing that, but what I did last time was I just shortened the time frame, because to be honest, I'm not gonna lie to you, I am very uncomfortable rolling trades. Like having a trade on, having buying power that's taken up that I cannot use, right? I cannot use it to make money, right? And I got to the point where I do have confidence that I can make up the trade, and if I can make it up in 2 or 3 winning trades, I'd much rather hurry up and make it up in 2 or 3 winning trades versus me holding a position an extra month just to say that I closed out profitable. So that's the dilemma there. We also made, not one, but 2 bad mistakes in these other 2 positions, right? Selling options on stocks during earnings seasons. And I did it for both my other 2 positions, right? I did it for Boeing and I did it for Alibaba. So what does this mean? So the expiration date is February 21st, right? That's the expiration date for both of these trades. And lo and behold, look at the next earning date. It is coming up this week. It's coming up this week for Boeing, and it's also coming up this week for Alibaba. Well, not for Alibaba, not coming up this week, but it's coming up during that time frame, right? Now, Alibaba doesn't scare me as much, and I was also, if you were paying attention last week, the same earnings date was going to be for NVIDIA. NVIDIA was going to be same February 13th earnings announcement date. And I learned this lesson when I lost the most money in April of last year. I lost maybe 3%. And it was essentially a similar setup I had to this month. I started off just fine, and then I got into a position of losing trades because of earnings. Even though the stock was moving going up, moving in the direction I wanted it to, just because it's earnings season, naturally there's more volatility in the air. And there's usually a certain way you can trade options to make money during earnings season. And for me, it's just tough because during earnings season, I just don't have that many trades. I don't have that many possibilities. I went from, okay, as long as within my typical time frame, as long as the earnings date is not within that time frame, I should be fine. But now what I'm experiencing, particularly with Alibaba, is that, and don't get me wrong, part of this is because Alibaba's going down. And maybe this would change. Maybe my original idea will work. It's just that Alibaba is going down, which is, it just make me feel the pain even more. But it's don't put on a trade unless, the expiration date happens before the earnings announcement, right? Just do that. Just trade like that, which really limits my opportunities. So I looked into this, and last year, you essentially broke out my monthly trading from earnings months. So that's January, April, July, and October versus non-earnings months. Non-earnings months, I was averaging 4.5%. I'm not saying I can pull that off, and that's partly because there were some 6 and 7% months that were totally unexpected. I was just churning and doing really great, right? I was gaining a lot of confidence during those months, but that's a little bit of an anomaly. I don't expect that. But the earnings ones, I was essentially flat. I had 2 losing months. I had one where I lost over 2%. I had another one where I barely lost money. I had another one where I barely gained money. My first month, I got lucky, and I didn't even know I got lucky, and that's the only winning one, right? So it's learning my style and learning what not to do, and it's I literally have this down. Like I've mentioned before, I'm literally building a course, and that is one of the rules, right? Don't trade during earnings announcements. And lo and behold, How did I make that mistake? Not once, but twice. So literally, all three of the positions I have on, I am not a fan of. Like, I'm not even paying attention to what can happen next. I'm not even looking at that, right? I'm not even looking at the possibilities of moving forward, right? Or adding any extra trades on. I'm just looking to get out of these three, right? And then we'll worry about making money again, probably next month. Now, let's move to the stock market news that matters. So, of course, like I mentioned before, I love me some Market Watch, so we're going to touch on it. Speaking of earnings season, a lot of firms that are part of the Dow index are going to be reporting in the next week or so. And this is really important because through the first half, it hasn't been so great. Like, literally, earnings have been flat for the first half of companies. So out of the 30 companies, first 14 relatively flat. Now, is this partly because their banks is skewed to the financials, and that's maybe why this is happening? That's a possibility. You got other companies coming out like Apple. I already talked about Boeing. I don't know why this reloaded. I already talked about Boeing, Microsoft, McDonald's. More tech names. Facebook, Amazon, AMD. Like this, GE. There's a fair amount. There's a fair amount of names coming through, and if they do well, usually what happens during earnings season is you need one of these 30 companies to do well or not. If they do well, then the entire market's going to move up. If they don't do well, the entire market's probably going to move down. Is that a fair barometer to base day-to-day moves off of one company's earnings? No, but it is what it is. That's how the market moves. Second, and this is something interesting. Why this coronavirus outbreak that's happening in Asia right now could actually trigger a stock market pullback? Now, keep in mind, and I've mentioned this before, the stock market, you're measuring things not in terms of how much you can lose, but how much uncertainty is in the air, right? That's where volatility comes from. That's the basis of options pricing, right? How much uncertainty is in the air. When there's a lot of uncertainty in the air, option prices are great. They're juicy. You really don't have to take that much risk to make money. When there's a lot of certainty in the air or just low uncertainty, like, for example, today, if you look at the VIX index, it's below 15. That's kind of my gauge for how much, if it's low uncertainty or higher uncertainty, right? Because of that, you gotta worry about some things. Now, when something like this breaks out in China, this is part of the downside of having more of globalization, more interconnected global economy. Because if China slows down, it slows down trade everywhere else, right? They're that connected. It slows down trade everywhere else. It will eventually flow through to the U.S. And that's from the business side. We're not even talking about like people traveling to China and coming back here and spreading it here. That's totally different. That's like next level of worries. So that can be an issue. So this is actually something you should pay close attention to if you're in the markets today. Pay close attention to this coronavirus. I don't even think I'm saying that right, but it is what it is. But pay close attention to it, because if things start spreading and you get an outbreak in the U.S., best believe the market's going to drop by like 3 to 5%, just automatically, instantly. It's just going to happen. So pay close attention to it. It might not be that big of a deal overall, but it seems like it is. It's big enough where it's making the news, it's making its rounds, and there's real fear in the air. And when fear starts to get into the air, this works out as an option seller because you can take much less risk and still get the same profits. So that's something I am kind of looking forward to. I'm just like, God, get me out of January. Let me get to February so I can go back to making money again. Don't let these trades kill me. Now, YouTube shout out. We're going to actually shout out an investor I've been keeping up with for a little bit of time, and I love his videos, and it is the Swedish Investor. So the Swedish Investor just came out with a video called The Acquirer's Multiple, which is a book I've actually read. And it's a really good book. And this is his channel. And essentially, the Swedish Investor, what he really does is he reads a whole bunch of books and he talks about the top 5 takeaways from each of those books, right? And they're all finance and investment and making money related, right? So if example, we got the cash flow quadrant here. You got the Money Master one from Tony Robbins. You got How to Win Friends and Influence People. You got the 4-Hour Work Week. Some well-known names and some not so well-known. And the Acquirers Multiple is one of those not so well-known, but it's really good. It really just talks about if you're going to buy stocks, if you're into investing stocks instead of options, if you're going to do it, look at it from like buying an entire company's perspective, not from buying the stock. So don't look at the price to earnings multiple. Look at the enterprise value to operating earnings multiple. That's the multiple to look for. And enterprise value is the market cap. So you look at the same number, but you add debt and you subtract cash. If I did that right, I'm pretty sure that's the way you do it. Anyway, check it out. Check out the video. It's pretty good. And yeah, that's definitely the way to go. Swedish Investor is really good. I watched a ton of his. If you can't tell by all the red bars, I have watched a number of his videos in the past, and I'm gonna keep watching them. It's a lot of good information, and I think you should too. Now, what we've all been waiting for. Talking about the Super Bowl, my Dallas Cowboys blues, and what you can learn to become a better investor. Now, first off, I would like to congratulate both the Kansas City Chiefs as well as the San Francisco 49ers for getting to the Super Bowl. It's a big deal. It's a big achievement. I mean, it is hard making it to a championship game on any level, let alone the NFL, right? The best of the best, which is really great. But I must admit, it is hard not thinking about things from my perspective as a Dallas Cowboys fans. Why are we not in the championship game? Why haven't we made the Super Bowl? What's our issue this year, right? And don't get me wrong. I mean, I'm from Houston. I am a Texans fan too. Deshaun Watson, what's up? That's my guy. But yeah, just the timing of everything, I've just became a Dallas Cowboys fan. And when you look at the teams, like the players are there, the quarterback's not that bad. We got the weapons. Why aren't we better? And it really comes down to this after looking harder at not just these Super Bowl teams, but looking back at national championship or who makes it to the championship game in pretty much any sport. What it takes is being great to just phenomenal on one side of the ball without being horrible on the other. That's really the secret formula. It's not as complicated as we think it is. You're either great on offense and decent to good on defense, or vice versa. You're great on defense, good to decent on offense. And that's what we have here. We have the Chiefs, who are just flat out amazing on offense, and the defense is underrated. They're at least decent. And on the other side, you got the 49ers, who just phenomenal defensive team, pretty good offense, right? You have that going on. And of course, when I think about the Dallas Cowboys, I think we're good on both, maybe slightly better on offense, but it didn't always show, right? It didn't always show, and I think that's the real hurdle that Mike McCarthy is going to have to jump through. So in my mind, I'm thinking be great on offense. You got to take Dak Prescott's game to the next level, be great on offense, and just be good on defense, which I think we were for the most part. Just be good to decent defense and then elevate the offense. But, it's up for him to make that decision. But overall, what can you learn for your investment? How you're approaching the investment world? You need to pick one side to be great on and the other side to be decent on, right? So you're either going to be great on making money or investing and all of that, and you're just going to be good enough on defense, which is saving money, or vice versa. You're going to become a financial minimalist or, join the FIRE movement and you're going to save up a whole bunch of money, but you got to do something with that money and you have to learn how to invest or at least be an entrepreneur. Hell, get a side hustle to help you get there, right? That's at least being decent, right? It is hard to really make it, especially make it in a shorter time frame, right? I'm in my 20s right now, wait till my 60s to retire. It is hard making it without being great on one side or the other. And most people take the defensive route. It's an easier route to understand. We're going to try to save up as much money as possible. And then they realize, man, you can't really enjoy life doing it this way. I mean, don't get me wrong. I'm a fan for delayed gratification, but you can't really enjoy things, right? you have to skip out on a lot, and you have to keep telling yourself like, hey, I'm gonna get there eventually. But you don't want to get there eventually when you're in your 50s and 60s. No, getting there eventually is in your 30s or 40s, in 10 years. I think people can make a sacrifice for 10 years. I think that's why FIRE got so popular. In a lot of people's instances, it's a 10-year sacrifice. It's a hard one, but you at least know there's light at the end of the tunnel. So you can do that, but also at least be decent in investing or decent in making extra money. These sorts, don't just depend on your day job, the multiple streams of income thing. I decided to take the opposite route, become great at investing. I cover hedge funds every day. I get to learn how they think about the world. And that was the route I wanted to take and still want to take. My issue was I did not do a good job holding down the cost of living. Like, my living expenses creeped up every time I started making more money or become a better investor, right? So for me personally, I still want to be great at offense. I think I'm getting there, right? I think I'm getting great at offense. I just need to be good enough on defense. Hold my costs constant so I can have more money to invest, and that's how I'll get there. So, how are you all going to get there? You're going to focus more on offense. You're going to go more on the investing side. You got real estate. You got all the other ways to get financial independence. You're going to start a business. Or you're going to focus more on the defensive side, which is essentially save as much money as possible and become a financial minimalist, right? So, tell me which side you all are thinking about and which side you actually think is better overall, right? Let me know in the comment section below. So, that's all I have for you all for this week's episode. Next week's episode, we're going to be touching more on Black History Month. Very exciting time. Love Black History Month. And I'm going to talk about my favorite person from Black history, Booker T. Washington. I'll see you next week. Thanks for watching, and stay sophisticated.